So why do wealthy people like whole life insurance? I'm going to start today's video with a story about someone who I think is just an absolute pro in the finance space. So recently, I got to meet a investment officer at a very large hedge fund who is one of the sharpest guys I have ever met when it comes to all things finance. Just zipping through numbers, spitting terms at me that I've never heard of. He's like a super sharp guy. So point is, he had reached out to our company because he was very interested in whole life insurance. A little bit of background on this individual. We had mentioned that he is currently a hedge fund investment officer at a very large hedge fund today, but his background and some of his experience, he had worked for Goldman Sachs before. He had also worked for JP Morgan, and a little bit of information on what he did for JP Morgan. He had actually led one of their divisions over in Hong Kong. So he spent about 6 years in China growing that branch of JP Morgan over there. So they're using him for that just because super sharp guy, understands numbers, understands business. Like, yeah, definitely want him on your team if you're growing a business. And before meeting with him, some of the comments he had mentioned just on the form when he had come across our website and said, I'm interested in life insurance for X, Y, and Z, it just immediately looked like something that we usually don't see. So what I did is just look him up. I looked him up and saw that he had been interviewed on several money channels like MSNBC and such, where a lot of times you'll see individuals in the US and individuals in companies globally go to him for advice as far as where he thinks the global markets are. So again, sharp guy when it comes to all things finance. So with all of that said, he was interested in whole life insurance. This is someone that understands what to do and what not to do with your money. So there are three main reasons why he was interested in whole life insurance, and they all centered around the cash value. Number one, he was interested in the cash value because he viewed it as a fixed asset. Specifically, he viewed the cash value growth as attractive, but particularly there's no maintenance there. He made a comment about comparing it to fixed assets that are offered at some of the world's best hedge funds. He said, when you look at the yields here, they're very comparable, especially when you combine it with the tax benefit that comes with the cash value growth. The difference is you don't have additional maintenance fees. You don't have a $5 million minimum buy-in or anything like that. If people understood how this worked with respect to the cash value growth, a lot more people would be interested in it. And it would also put some stress on hedge funds with respect to the fixed assets that they offer, which I thought was an interesting comment he made. So that was the first reason why. Fixed asset, which means the money just grows safely on his balance sheet. Number two, it's very easy to access his money. So if he wants access to this cash value for an opportunity, he can get to it quick. So if you have a whole life insurance policy and there's cash value in it, if you say, hey, I want to get to some of that money through a policy loan, there's a few different options. You can call your agent, you can call the insurance company, or you can just go on your online account or mobile app and request a policy loan, and it hits your bank account typically within 2 to 5 business days via ACH. So super convenient in that respect. So we like that. And then here's the big one. He really liked the tax benefits. So with the cash value life insurance policy, if we do everything right, that means the agent does everything right when they set the product up, you can use it completely tax-free. So he does very well financially. He also lives in New York, so he is going to pay a lot of income tax. So when you look at any type of asset that has tax benefits being tax-free, that's going to be very attractive. Let's go through how he looks at it and how a lot of people look at it. So here's a life insurance illustration. We just got it on Excel. We've got a total of how much going in here? $250,000 per year for 4 years. That's a total of $1 million, and then nothing thereafter. So you've got the cash value, death benefit, and then you have what is called the dividend rate. This is the dividend interest rate that is paid to all whole life insurance policies with this particular company. So at the time that we prepared the illustration, the dividend rate was 6.1%. Here's a question. If you see $1 million in cash value and your dividend rate is 6.1%, what do you think your money should grow by? What's 6.1% of $1 million? If you've got $1 million at 6.1%, that would be $61,000. Does the cash value grow by $61,000? He's at $1 million. He pays in nothing, and it grows to $1,050,000. That's not 6.1%, is it? No. Here's why. The dividend rate is a gross rate when it comes to the growth of a life insurance policy. We never want to assume that because this can be extremely confusing when we see a percentage there. He, of course, wanted to see the net rate of return. So there's two steps we take here. Step one is looking at the net rate of return. So here we've got your annual ROR. ROR stands for rate of return. And this is just showing the yearly growth rate. Think of it as your annual yield. It's negative in the first year. You know why? Because you paid in $250 and you only have $224. So you have less than what you paid in. But as time passes, it gets better and better. Does it ever hit 6.1%? No. Gets attractive, tops out at about 5.25%, but this is displaying the net growth rate. We're simply just measuring how much the cash value is growing by and turning it into a percentage. This way we can see the true growth rate on our cash value. Does that make sense? Key takeaway, if you're trying to see this number with a life insurance policy, I would just ask for the annual rate of return or yearly rate of return. If you say those words, you'll get that report from a life insurance company or agent. The next thing we can look at is the fact that he pays a lot of taxes. So if he has a 40% tax rate and he can get 5% tax-free, how valuable is that to him? It's valuable. So we have what is called a taxable equivalent. And what this shows is what he would have to earn in a taxable account. Then after accounting for taxes, it'd be worth the same amount over here. So for example, if we look at age 50, we see 7.5%. So that means if I have my money in a taxable account, my tax rate is 40%, after I account for the taxes, so I earn 7.5%, pay 40% taxes on that, I'd be left over with 4.5%. Make sense? That's what that taxable equivalent column means. And with that tax rate, if he says I'm in a higher or lower tax bracket, we can easily adjust that and we'll see the impact that it has on our taxable equivalent. So back to the 3 points, the tax benefits. He was very attracted to this because he can use that cash value tax-free. Even if he doesn't use it, he knows that he does not have to deal with taxes as it grows over time. So what made him reach out? Well, he was shown a whole life insurance policy, and the policy that he was shown by someone else is what I'll refer to as a great example of exactly what not to do. Meaning he was shown this policy, it was by someone that he knows, but the numbers just did not speak to him in a way where he said, I'm comfortable putting my money here. So here's the policy that he was shown. It was this exact product. Here we go. A lot going on here. I just want to start up here. We've got $100,000 per year going in. Got all these columns. I just want to focus on this one because this is what he focused on. And he saw this and he said no. He puts in 100 grand. he has $30,000 right out of the gates. That means you lost $70,000. After 5 years, if you pay $100K per year, how much did you pay? $500,000. How much did he have? $382,000. It's a $120,000 loss. By the 10th year, $100,000 for 10 years is a total of $1 million. What does he have in cash value? Finally has $1 million. So it took 10 years just for him to get his money back. So he looked at that and more or less just said, no thanks, I'm not interested in that at all. And then started doing more research as far as how to get a policy that is truly set up for as much cash value as possible from start to finish. Because he has heard of this before. He actually had an older policy for about 8 years. So he's got some insight as to how this works. So he had some questions here. First, he asked about different products. And the products that we focused on, we talked about more than this, but we focused on what's called a MassMutual 10-pay, a Guardian L95, then also a Guardian 10-pay. High-level overview. A 10-pay product with both of these companies is designed for cash accumulation from the insurance company's perspective. So when he is focusing on the growth rate, being the rate of return, those, particularly based on the non-guaranteed side of the illustration, based on the current dividend rates, those 10 pays will look the best. So they are going to have the lowest death benefit upfront, but the highest cash value. And long term, they'll have the highest cash value and the highest death benefit, which is interesting. And then you've got the Guardian L95, which I always like to show because you can carry a low minimum premium with this product, and it has very attractive guaranteed cash values. So if I like seeing strong guarantees, and I like seeing a lot of cash value up front, where I don't take this big hit initially, that product is very attractive. So we looked at those three, and he narrowed things down to the 10-pay products. That is really what he preferred the most. So he asked about different products that are available. Then he asked this: how do commissions work? So to answer this question, let's look at a workbook that we have that just shows the commissions were paid with different companies. Sound good? All right. So here we go. And we've got 3 companies here, 2 major mutuals and a larger one. Let's start with Guardian, and you can see that L95 product here. So here, you've got a total payment of $100,000. And what you can see is what's called your base premium and then your PUA. So when you pay money into a life insurance policy, you can choose what goes to the premium and what goes to the PUA rider. All companies have limits as to how low you can set the premium. Typically, we want to set the premium as low as possible because this takes the biggest bite out of cash value, especially in the first year. Now, if we look at a company like Guardian or MassMutual, the lowest we can often set the premium is about 10% of the total payment. So he wants to pay in $100,000, premium $10,000. Okay. This also generates the bulk of the commission. So if I pay $100K per year and 10% is the premium, 90% is the PUA, the total commission in the first year comes out to about $11,000. And then there are renewals, but they're much lower. A lot of times companies will stop commissions after 10 years. Some will still pay you a 1 to 2% renewal, but it drops off substantially if they pay anything. So if he funds $100K per year for 10 years, that would mean a total of $42,000 in change over that 10-year period is paid to the agent. Divide that by 10, it's $4,200 per year, with the bulk coming up front. Make sense? Here's a different product with MassMutual. It's called a high early cash value product. which we didn't look at this option with him, but it's a different version where the commissions are much lower up front, but they don't take a big dip when it comes to the renewals. So same design. There's the annual commissions. There's the total over 10 years. And then if we look at a smaller company, the rates are much higher. So we see in the first year it's about $18,000 and richer renewals as well. Now the reason why is because this company does not offer life insurance in the state of New York. And if you don't offer life insurance in the state of New York, you're not subject to their regulations. One regulation is how much can be paid out in commissions. So this is with a 10% premium across the board. A lot of times what people run into, situations like this, where an agent will try to increase the premium on them. And we hear the reason you want a higher premium is because you can pay more money in for a longer period of time. No, look what's going on here. Like, look at that. That's often what goes on there. Anyway, let's get back on track here. Another question he had. I'd like to see a breakdown of different insurance companies' financials, particularly the two that I'm looking at here, Mass Mutual and Guardian. We also looked at New York Life, but he did prefer New York companies, not because of the commissions. He has almost zero interest in how the commissions work as long as the cash value is maximized for him. But he prefers New York companies or financial institutions that are in New York because of the regulations and requirements that those companies and institutions are bound to. If you're doing business in New York, there's a lot more work you have to do as a financial institution. So let's take a look at the financials here. And these are going to look like a lot of information because they are. I know, right? Look at that thing. So this is a report actually that is provided every quarter to banks. So banks want to see this information as far as an insurance company's holdings. This guy, being an absolute pro as a hedge fund investment officer, loved this stuff. Ate it up, went through it and said, okay, I like both Mass Mutual and Guardian. I can see they have different investment philosophies, but I'm comfortable with both companies. So those financials, if you can understand what you're looking at, can be very, very valuable. If you say, just tell me what to do, banks proceed with those companies after looking at those financials, and usually they make good decisions. Conservative banks, that is. Okay, let's take a look at his situation. So he is currently 44 years old. His income is in the 7 figures. There's some years where it's been in the 8 figures. But he's got about $5 million in a money market. So his plan is to move some of that cash from the money market into a whole life insurance policy. He does not want to move all of it, but that's what he wants to start with. So this is common when we see individuals with excess cash, whether it's in checking, savings, money markets, or other accounts. They say, I feel a bit overly weighted with assets over in this class. Let me move some of that over to a whole life insurance policy after I understand the benefits. So step 1 here that we looked at, company selection. Step 1, major mutual companies. We'll always recommend one of the 4 major mutual companies. The reason why really comes down to proof of performance. We've seen them actually deliver strong cash values to policyholders. And we're going to look at Mass Mutual and Guardian when we pull his numbers up. Step 2, though, is reviewing the actual numbers. So first, we'll look at $1 million over 4 years. And that'll be 4 even payments. So if you divide 1 million by 4, what do you get? $250,000 per year. So it'll be $250K per year for 4 years. Then we'll look at 4 million over 4 years. Then we'll look at a lump sum option. Let's take a look. Fun stuff, right? It is interesting just to see how individuals move large dollar amounts into these policies. And what I'll say about this, just as I pull everything up here, is these numbers are large. However, the same concept can be applied toward anyone. So here's our Mass Mutual illustration. We've got a 10-pay product, which is this guy right here. So here's our 10-pay policy. What do we see? $250K per year for 4 years. After the 4th year, nothing goes in. He can continue to make payments if he wants to. However, in this example, we set it up where he can stop altogether after 4 years. He can stop after 2 years, really, if he wants to. Here's his money column, where it reads net cash value. Remember the first policy he was shown with $100K per year going in? How long did it take to get his money back? 10 years, exactly. How long does it take to get his money back here? 4 years. The reason why is because how this policy is designed. Remember how commissions work, where that base premium was 10% of the total payment? Here's what you're going to see going on. Coincidentally, in the life insurance industry, the lower you set that premium, the lower the commission is, but the higher the cash value is. That's how the seesaw works when you look at a cash value life insurance policy, really no matter how you spin it. So here's the detailed illustration. Let's go back to Excel because it'll make things a bit easier. So there we go with Mass Mutual. We've got our annual rate of return, which shows the yearly growth rate. And then your internal rate of return really displays your average. And you'll notice that is in the red until you see the year that we're highlighted in yellow, which is the first year we have more in cash value than what we've paid into the policy. Make sense? And then you can see it grow over time. This is all based on the 2024 dividend interest rate. They recently declared the 2025 rate, which is 6.4%, but those rates will change as the dividend rate changes. So that's Mass Mutual. Then we've got Guardian, side by side. Now with Guardian's 10-pay product, one thing I don't like about it is when we look at level payments, not a big lump sum up front, they force a higher base premium, which takes a bigger bite out of the cash value up front, which is a lot of times a reason why we show that L95 as an alternative, because it shows people an option to have more cash value up front. Now, as time passes, break even is close to year 4. It's year 5 in this example. But that's still a big hit up front, isn't it? 17%. It is. So I would call the upfront cash value a disadvantage of Guardian's 10-pay product compared to Mass Mutual's. An advantage, however, is if we look at the funding flexibility, if the minimum premium here, this one's a little bit more than 40K, what you can do is have it set up where you're only committed to that. So you're only billed for a minimum amount, and then you can add the rest at your discretion. Whereas with Mass, typically we're paying the premium and the PUA at the same time. Which in his case, he didn't really care about that because he's got the cash on hand sitting in the bank. So that is a total of $1 million. Let's look at a total of $4 million. Same thing here. When you look at the returns, there's bigger dollar amounts going in. $1 million goes in, first year cash value, about 90%. Over here, $1 million goes in, first year cash value, closer to 83%. Long term, both look good. Here's one thing I'll mention, and this is some of the unseen that occurs in the life insurance industry. If I look at both of these and look at it at age 65, this one has more cash value. Does that mean I should pick this one on the left? Because I've got more cash value and more death benefit for that matter. No. Here's what I've always seen with any of the four major mutuals. If all things are equal in terms of setting the policies up with the minimum premiums, maximum cash value, one company, typically the one that has the higher dividend rate, will illustrate better looking numbers on paper. But in reality, I've seen too many cases of these guys going back and forth with each other, where if you said to me, hey, I'm working with another agent on this, I'm looking at both options, I don't know which one I should pick, I would say you could literally close your eyes and pick one of them out of a hat, and you can't go wrong with either of them. Again, provided they're set up the same way. That's important. But I say that because when we look at policies that have actually lived the test of time, we've seen that real proof of performance, which is so important. All right, last option. Do you remember what that was? The lump sum option. So he's got $5 million in a money market. That's a lot. And it's not like he's not putting anything else in it anymore either. So it's still growing. So if he said, hey, what if I want to get some more cash into this policy because it's just sitting there in the money market? Can I do that? Yeah, you can. So here's the option where it's just 4 level payments of $1 million. Here's the same product. And this is the same Guardian 10 pay, by the way, where we add a big old lump sum. So now you've got 2.2. You're close to 90% cash value in the first year in this example. But look at this. We got the $4 million in over 4 years. You just accelerated the things with that first year deposit. And if these numbers seem massive, you can take a 0 or 2 zeros off. And if everything is designed equally, you'll see similar numbers across the board. A lot of times people ask, hey, what if I just start with $25,000 up front and then do $5K per year thereafter? It's the exact same thing as long as the policy is designed the same way. But there's your cash value difference, which just shows how much more you have with this option compared to this option. Same product, same company. We looked at a different way of getting the money into the product, and that resulted in him having more money, which in his case is really the name of the game. How do I maximize cash value across the board? So, I know that is a ton of information. I do sincerely hope that it gives some insight as to how wealthy individuals use whole life insurance. I'll end with this. One of the notes that he had mentioned, or one of the things he had said in our initial communication was he feels like it is a crime how people don't understand how this actually works, which I appreciated him saying that because I feel like it just speaks to the fact that a lot of individuals don't understand whole life insurance and particularly the cash value piece, how to maximize it, how to look at the net growth rate over time, how to leverage the death benefit in the future if I'm concerned about leaving money, all of that fun stuff. So with that said, I do hope this helps. Let us know if you have any questions at all, and we'll talk to you soon. Thanks so much.